Right now, VSee Health, ticker VSE, is trading at $1.20. That's up 14 cents, a jump of 13.24% in midday trading on Wednesday, October 29th. The market is open and this stock is moving. And we have to be immediately clear about what's happening here, because this isn't a random meme stock spike or a short squeeze based on nothing. The expectation for a stock like VSee, which has been struggling under the $1 mark for weeks and even received a Nasdaq non-compliance notice, is that it's on a slow path to a reverse split or delisting. People see a micro-cap telehealth company and they think the story is over. They think the pandemic boom passed this one by and now it's just burning cash on its way to zero. That is the expectation. But the reality of today's 13% surge on massive volume that's already north of 61 million shares is tied directly to a fundamental, material change in the business that the market is only just now beginning to process. Yesterday, VSee Health announced it has received authority to operate, or ATO, at the FedRAMP High level from the U.S. Department of Health and Human Services. Now, for most people doing their self-investing, that sounds like dense corporate jargon. But for a company in this space, it is everything. FedRAMP is the government's security standard for cloud services. High is the most stringent level required for agencies that handle highly sensitive, unclassified data. What this means in plain English is that VSee's telehealth platform is now authorized for use by the HHS and, by extension, becomes a viable, approved vendor for other federal agencies that require this top-tier security. This isn't just a participation trophy, it's a key that opens a multi-billion-dollar government healthcare market that was previously locked. The company already counts NASA and the HHS as clients, but this authorization codifies their security posture and dramatically expands their potential footprint within the entire federal system. This single piece of news directly challenges the narrative that VSee is just a forgotten SPAC. The expectation is failure. The reality is that the company just gained access to one of the largest and most stable customer bases in the world. And this news isn't happening in a vacuum. It's the latest in a series of very intentional moves that the sub-$1 price has been completely ignoring. Just last week, on October 23rd, the company announced it had strengthened its balance sheet by eliminating over $5 million in legacy debt, a remnant from its SPAC merger. Cleaning up the balance sheet is exactly what you want to see from a management team trying to regain investor confidence. So you have a cleaner balance sheet, and now you have a massive new addressable market. But there's more. On October 21st, VSee announced it had secured a new multi-year teleradiology contract with a Level 1 hospital system. The company stated this contract is expected to generate approximately $10 million in gross revenues over 2 years. For a company with a market cap of only around $20 million, a $10 million contract is monumental. Management went so far as to say this deal could potentially double its annual recurring revenue. So let's put this together, because this is the reality that clashes with the dying stock expectation. In the last 10 days, VSee has eliminated significant debt, potentially doubled its recurring revenue with a major new contract, and secured the highest level of federal security clearance to go after the U.S. government market. Today's 13% jump isn't a surprise. The surprise is that it isn't higher. This is the kind of volatility that makes online investing so difficult for many. You can't just put this in a Schwab Intelligent Portfolios account and forget about it. This is an Apple stock which trades on predictable hardware cycles and ecosystem strength. This is a high-stakes, event-driven microcap. The volume we're seeing, 61 million shares, is astronomical for a stock with a float this small. This indicates that retail traders, likely using platforms like the Robinhood app or SoFi Invest, are piling in. The low price makes it accessible for Robinhood fractional shares, and the news is just good enough to trigger algorithm scanners and day traders using more sophisticated tools like the Interactive Brokers trading platform. This is a battleground. Now we must ground this in the risks. The expectation of failure didn't come from nowhere. The company is still fundamentally unprofitable, with an EPS deep in the negative. It's burning cash, even with a strong gross margin of over 60%. And that Nasdaq non-compliance letter is very real. The company has 180 days to regain compliance, which means it needs to close at or above $1 per share for at least 10 consecutive business days. Today's move to $1.20 is a fantastic start. This is day one if it can hold this price into the close. This FedRAMP news is a direct lifeline in that fight. But there's another piece of reality that just hit the wire today, and it's a perfect example of the cross-currents you have to watch. This morning, VSee filed an 8K with the SEC regarding a warrant exchange agreement. An institutional investor is exercising about 130,000 warrants for cash, which is good, the company gets cash. But that same investor is also exchanging 2.25 million outstanding warrants for 2.175 million new shares. This is the definition of a mixed bag. On one hand, it settles a large warrant overhang, which can be a drag on a stock. On the other hand, it is dilution. It adds over 2 million shares to the float, which can put downward pressure on the price. This is the kind of complex financial maneuvering that makes investment help so critical for new investors. You can't just look at the 13% gain and think it's all clear skies. There's a dilution event happening at the same time as the bull case news. So who is this company really? VSee Health isn't trying to be a broad consumer-facing telehealth app. Its business is a low-code or no-code software-as-a-service platform. It gives hospitals, clinics, and enterprises the building blocks to create their own specific, secure telehealth workflows without needing a team of programmers. That's why clients like NASA, DaVita, and McKesson are on their roster. They need custom, secure solutions, not an off-the-shelf product. This B2B model is stickier and has higher margins, but it's a slower, lumpier sales process. That 10 million teleradiology contract is a perfect example of a lumpy win. When we look at who owns this, it gets even more interesting. This isn't a favorite of big Fidelity or Vanguard mutual funds. Institutional ownership is tiny, at around 4.5%. This stock is not in your typical Fidelity ETFs or Fidelity mutual funds. This is why the stock is so volatile. There is no large institutional base to provide a stable floor. But look at insider ownership. It's over 56%. Management and insiders own more than half the company. They are heavily invested. When you see a company with high insider ownership start clearing debt and signing major contracts, it's a strong signal. They aren't just working for a salary, they're working to make their own shares valuable. This is the kind of investment thesis that aggressive, high-risk tolerance traders look for on investing sites. It's not for a Fidelity IRA's retirement account. It's a speculative position in an individual brokerage account. This is the perfect moment to ask. Comment below if you think VSee can hold the $1 mark for the 10 days it needs to regain Nasdaq compliance. Is this FedRAMP and teleradiology news enough to build a new floor? Or will the warrant dilution drag it back down? Looking forward, the setup is incredibly stark. The bull case is that this is a total turnaround story. The market is wrong, and the expectation is based on old data. The reality is a company with a newly cleaned balance sheet, a revenue stream that's potentially doubling, and a brand new high security clearance to access the massive federal market. In this scenario, a 20 million market cap is absurdly low, and the stock could, in theory, look more like a $3 or $4 stock as that new revenue hits the books. Traders on SoFi Active Investing might be betting on exactly this. The bear case is just as clear. The warrant dilution will cap the rally. The 61 million shares of volume are just day traders and Robinhood speculators who will take their 13% profit and vanish, leaving the stock to bleed back below $1. The FedRAMP authorization is great, but it's not a contract. It's just permission. They still have to win those government contracts, which is a long, slow process. And all the while, the company is burning cash. More sophisticated traders on Interactive Brokers might even be looking at this spike as an opportunity to short the stock, betting that the expectation of failure was correct, and this is just a temporary news-driven head fake. This isn't the kind of stock you'll find in a SoFi robo-advisor portfolio. It's a pure execution play. What we are seeing today is the market's violent, real-time recalculation of this company's future. The common belief was that this was a dead-end telehealth play, another failed SPAC destined for the OTC markets.